When we initiated coverage on Blackham Resources 12 months ago, their share price was just 14 cents. Since then, they have been one of the best performers on the ASX as their share price has risen by more than 500%. And with first gold production imminent, as well as the potential to increase production to more than 200,000 ounces of gold per annum through the possible expansion of their processing facility, we believe there remains significant upside potential in the current share price. Through this review, we take a brief look back at what Blackham achieved during the past 12 months, their targets for the coming year, as well as review our valuation. Blackham's share price success in the past year has been the result of a lot of hard work from management, as they have rapidly advanced the Matilda Gold Project to be on the verge of first production, which is due to commence in the coming months. The key highlights during the past 12 months include releasing both a pre-feasibility study and definitive feasibility study for the Matilda Gold Project. Both studies confirmed the project as a viable gold mining operation with initial production estimates of around 100,000 ounces of gold per annum. Released multiple mineable resource upgrades, which has seen the mine life double in the past year to around 900,000 ounces of gold. This was achieved through an aggressive exploration program with more than 55,000 metres of drilling being completed during the past year. Completed a $20 million capital raising, whilst also meeting all conditions precedent to draw down the $38 million debt facility. Commenced refurbishment of the processing facility and other associated infrastructure at site, and most recently commenced mining. This has resulted in the market capitalisation of Blackham increasing from around $30 million this time last year to more than $200 million today. So looking to the year ahead, the key target for Blackham is relatively straightforward. Commence gold production whilst achieving guidance. We expect initial production and cost guidance to be announced post the initial ramp-up phase of production. Blackham also plans to continue their aggressive exploration program as 3 drill rigs will remain on site for the foreseeable future. The aim of this program is to continue to increase the mine life at both the open pit and underground deposits. And finally, as highlighted in our recent interview with Managing Director Brian Dixon, due to the significant success of their exploration program to date, Blackham is considering increasing the throughput at their processing facility, therefore increasing production in the future.
So up until now we've been focused on execution of our 100,000 ounce operation on the free milling ore coming out of the Matilda Project. With the exploration success we've had around the Wiluna area, there's a lot of excess capacity in the existing plant. We're currently looking at putting in further mill capacity with a view to potentially doubling the production output. The existing plant has a lot of excess capacity within most of the areas, and so by simply putting in further mill capacity, we've got a very low capital opportunity to grow the annual production.
So with the key targets for the year ahead in place, we have reviewed our valuation for Blackham. We have increased our mine life assumption to just over 1 million ounces of gold. We believe this is relatively conservative given the current size of the mineable resource defined by Blackham, recent exploration results, as well as the ongoing drill program. We have slightly decreased our cost assumption whilst increasing our Australian dollar gold price to $1,750 per ounce in line with market conditions. This has resulted in our valuation increasing to $1.13 per share. However, as Blackham is assessing the potential of increasing the throughput capacity with the aim of increasing annual production, we ran a scenario to examine the effect this would have on our valuation. However, for this scenario to be viable, Blackham requires a significant increase in their mineable resource. Otherwise, the operation would cease production after only a few years at the increased throughput level. We therefore have increased our mineable resource by an additional 25% compared to our base case. However, believe it is likely the resource would need to be larger than our assumption before the expansion would occur. We have estimated that the capital cost to increase throughput to be $40 million, but will not take place until the year 2018, meaning production will remain the same for the first 2 years as per our base case. We have estimated that once the plant's throughput is increased, production would rise to between 180,000 to 220,000 ounces of gold per annum. This overall results in our valuation increasing to $1.78 per share. We look forward to further information regarding the expansion study being released in the future, as well as first gold production in the coming months.